And I just published a paper on the Substack yesterday on this. If you look at the fixed income markets, we have a $800 million, or excuse me, $800 billion debt wall coming due in 2024. Now, it might be a little bit early to start sounding the alarms, but just given the credit markets for this, given the durability of balance sheets, given the margin compression on the income statements, I'm expecting a pretty fair amount of bankruptcies to come up. I think there was 120 something so far this year of defaults. Don't quote me on that number, but it's somewhere in there. And that's expected to get much worse in the next year.
I do have to say that I am very surprised at the speed at which this rally has happened. It's almost like unbelievable to see where we came from. And then, I mean, especially in the NASDAQ, these last, 3,000 points seem like they happened in a matter of a month and a half. Like it's been a hard market to trade anything but long. At what point would you consider this a bull market outside of even with the fundamentals? Where does the market have to get to for you to say, okay, maybe this is not a trap, and maybe this is a market where the buyers do have control of the
Well,
broader narrative?
if all of a sudden Jerome Powell just decides to drop rates down to zero interest rate policy again, I don't expect it to get any better. And the reason why, going back to the fixed income markets, you have a few options in regards to this. So let's hypothetically say, and I also have a good example of this on my Substack of a company in this very position. Hypothetically say you have a $500 million maturity coming up in 2024. Your operating income is about 100 million and your cash is about $10 million, give or take. How do you expect to cover that cost?
Well, you don't cover that cost unless you float more stock, or yeah, you're just raising more debt to cover the cost, basically.
Exactly. So you have a few options. You can refinance at a higher interest rate, which will be detrimental to their bottom line. You can raise capital through stock issuance, which will also be detrimental to your shareholders, as well as if your equity holders see this coming, they're going to sell and make your cost of equity that much more expensive. So you have very limited options. And then, final option, you can
That brings
default and do a
that brings up a
restructuring.
that brings up a really good question for me to ask you. Given that and this rebalancing, I know the rebalancing is in the Nasdaq that's should be taking place here next week, right?
Mm-hmm.
Um, how do you think? Because what we've seen currently is these companies with crap tons of cash that are dragging the Nasdaq higher. You've got these major companies that are huge weightings, and when you look across the Nasdaq, yeah, some of the smaller companies are doing well, but that's not what's causing this Nasdaq to explode and go higher. You've got these, you know, mega caps that are just dragging this whole thing higher. Given
Mm-hmm.
given that and the rebalancing, do you think that's going to have a compounding effect, especially given earnings that we saw today and people taking profits off the table? Do you think the rebalancing is just going to compound onto that, and we could potentially see an even uglier market next week?
Yeah, I was looking at that. What was it? Those top names account for something like 50% of the NASDAQ.
Yeah,
And
it's insane.
yeah, it's incredibly insane. It's egregious. But my thought process behind that is you have two ways to look at it. You have the people that are buying the individual names and the people that are buying the index. When you buy the index, it drags everything up. When you buy the individual names, it just floats their market cap. So, with passive investing, as you were discussing earlier, that's going to drag up every single name in the NASDAQ. So you have that whole mentality behind it. Um, when it rebalances, it'll give those smaller names a bigger percentage of the Nasdaq. So it might not be a terrible thing if you think about
Well,
it.
that's also why I brought it up, because those smaller names are going to be the names that are going to have significantly more trouble with debt. So you're not going to have, your Apple has enough cash that you're not worried about your Apples defaulting on debt. They have tons of cash on their books. Some of these larger names are not going to be in the same position as some of these smaller names. And now we're giving the smaller names a higher weighting of the index itself. And if you anticipate some of these smaller companies that are in trouble with maturing debt, in my
Mhm.
mind, that would have a compounding effect, given that we're giving them a higher percentage rating of the index itself.
Yeah, so it all depends on how much of those companies' shares are attributed to the index and how much are traded on an individual name basis at that
I see what
point.
you're saying.
Hmm.
Well,
So,
even so, I
let's,
mean, don't when somebody the people that are maintaining these indexes, they're going out and they're given, you know what I mean? They have to hold the companies to maintain the index. So they have to go out and buy and sell these companies on a daily basis to.
correct,
So
correct.
how is that going to have? And my understanding was that essentially you've got these fund managers that are buying and selling and keeping everything balanced on a regular basis.
Yeah, correct. So their job is to match the index through the ETF vehicle, which is, by the proportionate amount of shares that are attributed to that specific company within the index. That's their primary job as far as that goes. So, you know, it's hard to say how, they'll correlate as far as, if one company goes under, how's it going to affect the broader index? If it's 0.0002% of the index, it ain't going to do shit. But, if it's a little bit bigger of a percentage, sure, it can have a little bit of pull.
Hmm, interesting.
So
Yeah, I
what
would
about
think that would have a negative compounding effect, especially if you're bearish. I think that would be something that you'd be
Yeah,
looking forward to, especially if you're bearish, given the fact that it's going to be some of these smaller companies that are going to, if you're bearish because of the debt that's pending and the increase in rates and the fact that they're going to either have to float more stock or refinance or default, I would think that would be a positive narrative for that bearish view that would give you even more conviction on that, the rebalancing.
oh yeah, absolutely. And think of it this way, as far as like the Nasdaq goes, this ship isn't going to be steered by those smaller firms. It's going to be steered by those big boys: Tesla, Amazon, Apple, Google, Microsoft. It's going to be steered by these guys. They're the ones with the oars, are the ones that are basically the ship. These other guys are there just to go along with the ride. So kind of think of it more like that. If let's say Apple has a crappy earnings next quarter and has crappy guidance, that's going to have a significant effect on the Nasdaq's performance versus, I don't know, what's another company that's in the Nasdaq, like
Pepsi.
Carvana or whatever. Like they have a crappy earnings. That's not going to do much to the total broader index.
Yeah. I don't know. I have a hard time thinking where given the price action, just strictly looking at price. I understand what you're saying from the broader macros perspective, but just given price, in my mind, we've been in a bull market for the last, I don't know how many months now, because
I
we just
mean,
Yeah,
see a
sure.
series of higher highs and higher lows.
yeah, for a select group of companies. Now it's broadened out very recently, but only very recently. I feel like has it actually broadened out? I feel like it's been very consolidated to just an AI hype. There's not, none of these value stocks have been really taken off. If you look at the Kathy Woods names, for instance, a lot of
Mhm.
those smaller companies, they haven't moved hardly at all. And very recently, I've been looking and hunting for a lot of those different names, or even some of these small regional banks as well, for like who's not actually going to fall apart and doing well, is just kind of pick up those, because as it's broadened out, it creates some opportunity. But really, I haven't seen a broad-based bull market to make me really convinced that this is anything but a bubble. And I've kind of looked at the continued melt up to also be a symptom of all the money that was printed that's just still slushing around in the market, even with the interest rates increasing. It takes 6 months for these hikes to actually affect the broader market and the economy. So I feel like a lot of what's happening right now, I was too bearish too soon as well. I mean, this whole rally has caught me off guard. I didn't make nearly as much on the way up as I should have. And so I've only just now feel like I got a really good handle on what things are going on, like in a macro sense. But I think that was my mistake, is like not anticipating how much money was still floating around, how much liquidity has still been provided by the Fed. I think that's more of like the symptom of what's going on, because it doesn't feel like things are great despite what the market might be showing right now.
I was going to say, so if you look at a few of the geopolitical aspects to it, so Biden administration just announced that they're going to be blocking semiconductor sales, and that's a lot of to China, blocking semiconductor sales to China. And that's a lot of what's been more so affecting like Taiwan Semi, and what could potentially affect NVIDIA as far as their AI chip expansion.
Yeah.
I don't know. Given the prices here, I think you have to lean short on especially AI, NVIDIA, and some of these companies. It's just for me, it's just a matter of price. It's a matter of price action. And we've seen these massive rallies. And if I was forced to take a position in a juicy stock, which these stocks are juicy, like NVIDIA is a juicy stock. It's a good trading vehicle. There's liquid markets. There's tons of attention. Tesla is another one. I just look at the price action and am a contrarian and think, if I have to take risk in here, I'd rather be leaning to the short side.